I'm Diane Lim. I'm Director of Outreach and Senior Advisor at the Penn Wharton Budget Model. And today I'm going to talk about the economics of tax and spending policies, a really quick overview of some basic principles that'll help you better understand the main effects of different tax and spending policies. So we're going to start by talking about why government gets involved in economic policy, the role of government, and the different goals that government may have in intervening in the marketplace. Second, we'll go into the microeconomic effects of tax and spending policies. Then we'll go into the macroeconomic effects of tax and spending policies, and that includes what difference it makes in terms of how you pay for policies. After that, I'll talk briefly about the difference between focusing on aggregate economic effects versus distributional, more household level effects, and why the kind of summary measures that economists use to talk about how the economy is doing or the effects of a policy are not always very indicative of how these policies will affect people or businesses at the microeconomic level. And then I'll just conclude by reminding everyone of all the different trade-offs that we've touched upon between different economic goals throughout today's lesson. One way in which this lecture is going to be different from maybe economics lectures you've had in college is that I'm going to use very few graphs or equations, or basically none. I'm only going to use illustrations occasionally to help tell you a story about why these economic effects are significant and what the mechanics of these economic effects are. So that's despite the fact that it really is, in economics, it's really always about supply and demand and marginal benefit versus marginal cost. So there are certain principles that apply universally when we talk about the economic effects of policies, and you'll see that recurring throughout the lecture. So first, why does government get involved in the economy? I'm not sure if you'll recognize this person, but this man is Adam Smith. He wrote The Wealth of Nations, and that book is often considered the beginnings of the modern theory of economics. In that book, Adam Smith talked a lot about the power of the marketplace in allocating resources. And that is what economics is really about. We study how individual and collective decisions are made and how our society ends up producing and consuming things, enjoying things in a world of scarcity or limited resources. So there are constraints, and that means that choices have to be made carefully and trade-offs have to be faced. So economists tend to view the marketplace on its own as generally doing a pretty good job in influencing these decisions. In other words, that the invisible hand of prices and how prices adjust as demand and supply change. Prices serve as signals that give people cues as to whether they should reduce their demand or increase their supply. And we generally, economists tend to be taught that the market usually works pretty well. But we're also taught that sometimes it doesn't work so well because it may not be conducive to certain goals that society has that are beyond resource allocation or efficiency. So here are some of the reasons why we're not willing to leave it all up to the marketplace without any government intervention. One reason is because of market failures, where private values don't match up with social values. So we see the signals of how prices adjust to supply and demand, but those signals are only driven by whatever's exchanged in the marketplace. If there's certain things that aren't exchanged in the marketplace, then there is no market price, and we're not able to see or measure how much demand or supply for certain goods and services that are not exchanged in the marketplace, how those supplies and demands change. Second, even if we think that, even if everything were allocated in the marketplace, we may not like the allocation, the distribution of resources, the distribution of economic capacity among members of society. And so we may deem that even if the overall level is good, strong, and even if the allocation across different types of goods and services is good, we don't like the distribution of income. And so this is a role for government to redistribute income if it's deemed that the distribution with the market on its own is too unequal. Third reason, some things that we enjoy in society that we like to consume are inherently public or shared in consumption. These are known as public goods. There are a lot of things that are inherently public goods. Clean air is a public good, inherently public good, because one person's consumption doesn't prevent another person from consuming it. So we share the consumption, it's joint consumption, and yet in that case, we need government to pay for those things, because if we relied on the private sector to pitch in, for everyone to individually pitch in how much they value it, people would tend to free ride. They would know that they could just wait till someone else pays for it and still enjoy the consumption. So those are inherently public goods that government really should provide. Another reason that government may want to intervene is because the economy on its own is susceptible to business cycles. So there's a long-term path of the economy that over the long term it grows, but we have periods where there's low demand relative to supply, where we have a lot of unemployment and a lot of idle productive capacity, and that's called a recession, when we're far below what our potential output could be. And if we want to soften the blow, cushion the blow of economic recessions, then government intervention can be helpful to try to stimulate demand when the reason for unemployment is a lack of demand, not a lack of supply. Another reason is paternalism, that there are some choices that government may feel they're trying to help individuals make choices. They're trying to steer individuals toward making better decisions for those individuals' own good. So things like, requiring that people wear seat belts. A lot of regulation policy may be motivated by paternalistic type ideas, but we can also do it through tax and spending policy too. We can subsidize things that we think people should do more of, that they don't know is for their own good, like subsidize taking better care of yourself health-wise. We may want to tax activities that we think actually cause people harm, personal harm, where people tend to underestimate the costs. So we may want to raise taxes on cigarettes or alcohol. Those are sometimes called sin taxes, and that's kind of got a value judgment in there that suggests that they're motivated by paternalistic goals. Finally, just more broadly, our society may want to pursue longer-term goals that just are so long-term, so far-sighted in nature that the market hasn't really priced them adequately, even if it could price them. We don't see them being signaled in the current marketplace. So longer-term goals, prioritizing things that maybe don't benefit current generations but would benefit future generations, is an example of a long-term goal that government really will have to initiate efforts toward things that'll benefit future generations who aren't even born yet and certainly don't vote. So those are some reasons why government wants to get involved in the economy and doesn't want to leave it all up to the market alone. So let's go on to talk about the microeconomic effects of tax and spending policies. Microeconomics is all about how individual households or businesses make decisions. And so when we talk about policy effects, we're talking about how will a tax or spending policy influence decisions that a household or an individual would make, such as how much to work, how much to save, what to consume, like how to spend their income. Those are microeconomic decisions at the household level. Government policies, these tax and spending policies that we're considering today, can affect these decisions, these micro decisions, in two ways. So I'd like you to think about what we see as someone's response to a policy change is a total effect. There's separate forces that influence that total behavioral response that we see. So one effect is called a substitution. It's that when we change a tax or spending policy, we tend to affect relative prices. So if we raise a tax on a particular good, we make that good relatively more expensive than it used to be compared to other goods. If we subsidize a product, if we subsidize an activity, for example, we tend to incentivize people into doing more of that thing that government is subsidizing and less of other things that they could have done. So there's a substitution toward things that have become relatively cheaper and away from things that have become relatively more expensive. And this is an effect that I'd like you to think about as holding real income or purchasing power constant. I want to think about, well, what if I had taxed that good and given the money back to the person so that their real income was held constant? So the substitution effect is just isolating the relative price effect and ignoring whether the person feels rich or poor. The other effect is therefore the actual effect of feeling richer or poorer on people's consumption or other decisions that they make, and it's holding the relative price effect constant. So every tax or subsidy policy or spending policy has both effects operating, because you're either better off or worse off, and you're changing relative prices in a certain way. The total effect is the sum, but when you're considering ahead of time what might be the likely effect on household behavior of a certain policy, you really have to figure out, how is the substitution effect working, and then how is the income effect working, and do they go in the same direction or opposite directions? Because if they do go in opposite directions, it means that theoretically the total effect is ambiguous. And we unfortunately often have that situation where income and substitution effects go in opposite directions. I'm going to run through a hypothetical policy example for practicing substitution versus income effects. I'm going to start out with kind of a very non-real world example of a tax. We're going to consider a new or higher tax on Pinot Grigio wine. I'm intentionally picking a pretty narrow category, a very targeted tax policy, and I'm saying, suppose we only raise the tax rate on this particular kind of wine, Pinot Grigio. And then let's think about the substitution versus income effects. Okay, first of all, with all these taxes that we're going to consider, taxes reduce real income. And so the income effect for all these things is going to be in the same direction. It's a negative income effect. And then we have to think about what's the effect of people that consume whatever's being taxed, feeling poorer. But the substitution effect is going to be quite different as we consider these different tax bases. So if there's a higher tax rate on Pinot Grigio wine, then you can imagine that it would be pretty easy to avoid paying that tax, even if you really like Pinot Grigio wine like I do. And the way you would substitute, or the way I would substitute, is I would just start buying some other kind of white wine, right? So it's really easy to substitute out of Pinot Grigio and into other kinds of white wine. And so the substitution response, that effect, is pretty high. It's so high that I may completely avoid paying any of this new tax. So it's an easy response, and so we expect the substitution effect will be very big, perhaps so big that there's no income effect of the tax. Second, let's consider a little broader base. If the tax were to be on all white wines, then think about what people would do to avoid that tax. They would be able to substitute into red wine, for example. That's the most natural one we can think of, or substitute into beer. So a new higher tax on all white wines is going to also have a substitution effect that we expect would be pretty significant, that it's pretty easy for people to avoid paying the tax by changing their behavior, and that means there's a pretty big substitution effect we expect. Notice that the higher the substitution effect, the less revenue you're going to raise from the tax, and also the more you're changing behavior with that tax. So let's think even more broadly. All wines. If the tax were on all wines, or the higher tax were on all wines, then, of course, you can still avoid that tax by not consuming any wine. You could consume other types of alcoholic beverages. You'd expect that it's a little harder for people who are wine lovers especially to substitute from an all wine higher tax than the all white wine higher tax. And so as we're broadening the base, you're seeing that the substitution effect probably is going down. Broaden it still further to all alcoholic beverages, and this is where you have a harder time imagining that people will have a large substitution effect and substitute away and stop drinking alcohol in order to avoid paying the tax. So there may be some substitution effect, but notice that for this broadest base, all alcoholic beverages, that base is expected to generate a smaller substitution effect than all the narrower bases above. But we could go broader still. I could say, what if there's a tax on all beverages? Really, the only way to avoid that tax is to not buy in the marketplace any beverages, to just, turn on your sink, drink tap water. And so the substitution effect is lower still. Means that a tax on a really broad base like all beverages is going to raise a significant level of revenue. You could almost assume that behavior doesn't change when you're trying to do a revenue estimate. There's not much of a substitution effect away from the base. So you can almost take the current level of consumption of all beverages and multiply it by the higher tax rate. In all cases, all these cases, as I went from narrower, from Pinot Grigio wine as the base, all the way to the broadest all beverage tax base, notice it's easiest to avoid the narrowest base tax, so there's a big substitution effect. It also means that the big substitution effect allows one to avoid the tax really easily, so there wouldn't be as big of an income effect. And as we move from the narrowest base to the broadest base, the substitution effect gets smaller, but it's more and more likely that people will not change their behavior in order to avoid the tax, so they will pay a tax, and there will be income effects, meaning people's real income will go down. They will feel poorer as a result of this new higher tax. And to talk about sort of how income and substitution effects can go in opposite directions, I have this little puzzle that under any of these policies, how is it possible that my own purchases of Trader Joe's Pinot Grigio could actually go up? The first thing you have to know about this puzzle is that Trader Joe's wine, if you don't already know, is very inexpensive. I think I can buy a bottle for like $3.99. So given that knowledge, the answer to the question is that the income and substitution effects go in opposite directions. It may be true that I should reduce my purchases of Trader Joe's Pinot Grigio wine and any Pinot Grigio wine under any of these taxes, because the price of Pinot Grigio has gone up relative to other beverages. But on the other hand, if I am a big Pinot Grigio consumer, my real income is going to go down because of this new policy of taxing Pinot Grigio or any other kind of wine. I'm going to feel poorer. I'm going to want to make my money go further. And so one way that I can cope with the tax on Pinot Grigio wine or any of the other broader based taxes is to increase more of my purchases of cheap Pinot Grigio as opposed to expensive Pinot Grigio. So it is actually possible that before the tax, I tended to buy more expensive Pinot Grigio. After the Pinot Grigio tax or any other of the beverage taxes, I buy more of the cheap Pinot Grigio because that's the way that I can continue to get as much Pinot Grigio as before without having to actually spend more money. So I make up for the tax by changing the quality or the price of the product I'm consuming. If you took a fundamentals of economics class, principles of economics class, you would recognize this. Trader Joe's wine might be considered an inferior good that you actually buy more of as your income goes down, even if relative prices don't change. So an inferior good is when you actually increase your consumption of that good as your income goes down. And this is an interesting side note, is that in the real world, federal taxes on alcoholic beverages are per unit. So they're based on the type of alcoholic beverage, like whether it's beer or wine or distilled spirits, hard liquor, and the volume. So it's a standard tax per 6-pack of beer rather than as a percent of price. So federal taxes, in other words, the tax that you'd pay on an expensive bottle of Pinot Grigio versus a cheap bottle of Pinot Grigio would actually be the same. And that implies that as a percent of price, it's actually a higher effective tax rate on cheaper products, cheaper beverages, than on more expensive beverages. You can think about how that affects substitution and income effects. Basically, because it's a bigger percentage of lower price, the per unit tax ends up generating larger substitution effects for lower priced items. Also, it affects income effects because if you think about it, it's sort of a distributional issue. A per unit tax is going to be relatively more burdensome on lower income households who tend to purchase lower priced versions of things. It's something that tax economists would label that can make the tax more regressive, relatively more burdensome on low income households than higher income households. And that can sometimes be a concern when we talk about distributional consequences of alternative policies. So that was mostly a hypothetical example where it's talking about a wine tax. I'm going to go through some examples of real world policy that you should spend some time thinking about. One is the increase in tax on earnings. Economists are most concerned about the effect of taxes on labor income in terms of how it affects people's incentives to work. And so to participate in the labor market, to be in the labor force, and how much to work. An increase in the tax on earnings, the substitution effect is that it reduces your net of tax wage rate. So it reduces the return on each additional hour of work. Economists like to talk about this as saying it decreases the price on leisure because when you take an extra hour of leisure, you're foregoing wages. If you reduce net of tax wages because you're raising the tax on earnings, then the price of leisure, the implicit price of leisure, has gone down. It creates a substitution effect that encourages people to take more leisure, which has become relatively cheaper, and reduce labor supply, reduce hours worked. So the substitution effect is that people should want to work less. But the income effect works in the opposite direction because the income effect is obviously that when you have a higher tax on your earnings, your real income is going down. When you're poorer, you feel like you have to work more to kind of make up for the lost wages. And also because when you're poor, you can't afford to take as much leisure as when you're richer. So the income effect of an increase in tax on earnings is to increase labor supply, whereas the substitution effect of the tax on earnings is to decrease labor supply. So in theory, the total effect could go either way. And in fact, economists typically have found that income effects tend to be really a lot more important for lower income households and substitution effects more important for higher income households. And that's because lower income households are more constrained by income. And so that effect of any policy on real income is really a dominant effect. Also, because lower income households tend to have a harder time substituting away from things that are becoming higher taxed. You know, they don't have the luxury of going into the employer and saying, you know, my marginal tax rate on my income has gone up, and so I'd like to switch my hours of work from 40 hours a week to 38.5 hours a week. Most of us can't do that, but someone who's like self-employed would have an easier time adjusting hours, and a lot of those self-employed workers tend to be higher income households. So flexibility in adjusting one's income tends to be greater at higher income levels, and so substitution effects tend to be larger at higher income levels. Similarly, increase in tax on capital income. If you raise the tax on like interest income, you're going to reduce the net return to saving. That's going to discourage saving. On the other hand, the income effect is that people want to save more to kind of make up for the fact that you're earning less on that saving. You want to kind of hit a target level of saving. So income and substitution effects on saving from a tax on capital income also work in opposite directions. We can't really predict the direction of the total effect, whether savings will go up or go down when we increase the tax on capital income. Itemized deductions. These are a little easier to think about because these are subsidies. We subsidize a lot of activity through the tax code, so you don't have to spend, government doesn't have to spend money on the spending side of the budget in order to subsidize. These are two examples of big tax preferences that are just subsidies on the tax side of the budget: the mortgage interest deduction and the charitable contributions deduction. These deductions make it cheaper to take out a mortgage to buy a home or they subsidize your charitable contributions. In both cases, you're encouraging that activity that's subsidized. And also, they're increasing your after-tax income. And so the income effect is also positive. So in other words, the mortgage interest deduction encourages people to take out bigger mortgages. And at the same time, the income effect also encouraging larger home purchases. So the substitution and income effects tend to both encourage that behavior. A carbon tax. A carbon tax is a tax on the carbon content of fuels. A carbon tax would have a substitution effect of people substituting away from using carbon intensive fuel sources. First, let's think about that. That's a pretty hard thing to substitute away from. So the substitution effect from a really broad-based carbon tax is going to be relatively low compared to substituting away from a tax on a more narrowly defined type of fuel source. The income effect, also because a carbon tax is not that different from a very broad consumption-based tax, the income effect tends to hit lower income households more severely than higher income households, simply because consumption as a share of income is much higher for lower income households than for higher income households. Especially energy consumption is considered a necessity good as well. Like even if higher income households drive more expensive cars, they would end up paying the same effective carbon tax rate based on fuel consumption as people who drive cheaper cars. And so the carbon tax would tend to be more burdensome, relatively more burdensome on low-income households. This is something we will talk about a lot when we do our tax policy lesson, which is going to be one of the elective topics, is talking about the distribution of the tax burden and how it depends on the definition of the tax base as well as the rate structure. So come back for that elective lesson on tax policy. And then I provided a couple other subsidized activities that the government is heavily involved in. The subsidized nature of health and employer-provided health insurance and subsidized retirement savings. Considering how employer-provided health insurance is subsidized, it's encouraged by a substitution effect, and the income effect on households is obviously positive. People are better off from having government subsidize the health insurance. And it's people who work for employers who provide health insurance that are most subsidized, most better off. Also, government subsidizes retirement benefits through retirement savings accounts where the interest rate is tax-free until realized, until the retirement savings is withdrawn. And that produces an incentive to save in those tax-preferred savings accounts. And the income effect is obviously positive for people, and especially the higher your income is, and if you can save in those tax-preferred accounts up to the maximum. Again, there'll be a lot more about these subsidies through the tax code in our tax policy module. And then you can think of some others, like it's great to practice on some of the policies that you may be working on in your job that have been introduced. Think about what they're doing to relative prices. Think about whether they're making people better or worse off. And think about adding those effects up. So in economics, there are lots of trade-offs because of the scarcity of resources, because we have constraints. One of the most talked about trade-offs that we discuss in public sector economics is the equity efficiency trade-off. This is a book that was called The Equality and Efficiency Trade-off. And the notion of there being trade-offs is because the broader the tax base, so we'll talk about tax policy, the broader the tax base and the more level or lower or even the tax rates, the smaller are going to be the substitution effects, right? Because you create less of a distinction between something that's gotten cheaper and something that's remained more expensive or gotten more expensive. So with the tax base and the tax rate, the broader the base, that allows you to set a lower tax rate to raise a certain amount of revenue. the broader that base and the lower the rate, the lower the incentive to change behavior to avoid the tax, and the more difficult it is to avoid the tax. And so that is considered a more efficient tax. So the broader the base, lower the rate, the smaller is the substitution effect, the more efficient is the tax. It means that that tax is going to have less of a distortionary cost on decisions. So it's not going to distort economic decisions, behavior very much. And then most of the loss of well-being from the policy will be literally captured in the amount of revenue that's collected from people. So tax economists like to label that as having very little excess burden from the tax. Like most of the burden of the tax is just because it took dollars from people. People paid the tax, in other words. There's not much excess burden, which is the burden of a tax over and beyond the revenue collected. Excess burden is bad because it means that there are resources, there's economic capacity, economic activity that goes away because of that excess burden. It's just, sometimes it's called deadweight loss because it's not just transferred from private sector to government or from one type of household to another. It's just lost economic activity. Like it's economic activity that would have happened but isn't happened because people change their behavior to avoid the tax. So excess burden is sort of like the waste when you have to impose distortionary taxes. The reason Arthur Okun wrote about the equality and efficiency trade-off, and the reason there's a picture of this leaky bucket, is because the idea would be you can tax the rich and redistribute to lower income households, but there will be some resources lost along the way as those higher income households avoid the tax by reducing their labor supply, reducing their savings, basically reducing activities that are subject to the tax. And so the amount of revenue government will collect is less than the loss of activity that the taxed people engaged in. And so resources are lost as you try to transfer resources from higher income households to lower income households to promote more equality. There's a trade-off, equality and efficiency. There's a trade-off. You lose some economic activity because the bucket is leaky. The bigger the distortionary effects or substitution effects of the tax, the bigger the holes in the bucket. And the challenge is it's very hard to come up with very broad-based neutral taxes that are not likely to be viewed as unfair, because in the process of adjusting tax burdens to ability to pay, you have to have higher effective tax rates on higher incomes. Well, that creates a substitution effect, the incentive to reduce your taxable income. And that's what leads to reduced economic activity and the lost economic activity that doesn't get transferred to anyone else. It just doesn't happen anymore. That's the leaky bucket, and that's the trade-off between having redistributed policies and maximizing the level of activity in the economy. So that leaky bucket analogy and the fact that a lot of our tax policy and our spending policy is designed to redistribute income, and that we get that leakage out of the economy in taxing and subsidizing activities, leads to macroeconomic effects. Macroeconomic effects are about how policies are affecting the total amount of goods and services produced in the economy, as determined by the productive capacity of the economy, and also how much of the outputs of that productive capacity are demanded. So what we observe happening in the marketplace, in the economy, is the intersection of supply and demand, and the variables that we tend to focus on, these aggregates we tend to focus on, are GDP, which is total output, employment or the unemployment rate, those are macroeconomic measures, the capital stock, inflation is how fast prices are rising, and interest rates. So these tend to be the top macroeconomic measures you'd hear about in the news. So in understanding the macroeconomic effects of tax and spending policy, I like to frame this as there are a few questions you should ask in figuring these macroeconomic effects out. So the role and effectiveness of tax or spending policy is going to depend on the condition we are trying to treat. And so there are a few questions that we should ask before we figure out what kind of policy will do the best job. First, where are we stuck? In this picture, are we trying to promote an increase in the slope of that diagonal line that says that over time, real GDP rises? Are we trying to make the growth in real GDP higher over time? That's the supply side productive capacity of the economy. Where are we along that long-term supply side growth path? Or are we on one of these peaks and valleys? Are we in a recession where we're below potential, where it says trough, where we're headed down from peak to a trough? Or are we in an expansionary phase where we're at or even above that long-term path? So the peaks and valleys are sort of about where demand is relative to our productive capacity or supply side. And so the target of policies or the way we want to design policies will be different. Second, we want to ask, where would the policy that we're considering, where would the money go? Where would it land? And then once it lands there at the target, what would it do to affect behavior? And then finally, this is an area that gets neglected a lot by policymakers. Where did the money come from? How do we pay for the policy? That turns out to be critically important in terms of macroeconomic effect. So first question, where are we stuck? Is there insufficient demand for what existing productive capacity, the supply side of the economy, can produce? We're not at a level of demand that all of those productive things are at work. So this is an economy where you have high unemployment, or you have vacant office buildings, idle resources. They're there, they're able to produce, but they're not producing. They face insufficient demand to put them to work, whether it be a worker or physical capital. Or is it a lack of productive capacity? Like, are we constrained not because there are people that are unemployed, but everyone's working, all the buildings are full, and the only way to increase output in the economy would be we'd have to get more productive capacity. We need more workers because everyone's already working. We need more office space because all the offices are fully occupied. So that's called a lack of productive capacity on the supply side. And that means that it's not going to do us any good to try to stimulate demand when we already have everyone working. The only way to satisfy increased demand when we're fully employed is to get more capacity in the economy by bringing more workers into the workforce. And so that is a supply side constraint rather than demand side. Before I go on to where does the money land, I just want to point out that it is possible for an economy to both suffer from a lack of demand and a need to boost supply at the same time, especially in different parts of the country. So there's not one universal condition that we'd ever say, okay, the whole country needs to have more demand because there's a terrible unemployment problem in every single part of the country, in every single industry. We have a huge diversity of conditions geographically and across different types of industry and across different occupations. So it is difficult for policymakers to really come up with a macroeconomic policy intervention that we could say, oh, it's going to do the job everywhere we look, every part of the economy. That is a reason why we can think about it's not always going to be true that national level policy is going to be the best treatment for the ailment, whether it be a lack of demand or lack of supply. Okay, let me go on to the second question. Where does the money land and what does it do? So if the goal is to boost demand, if we're in a less than full employment economy, we want to get money to cash-constrained households and businesses such that as much of it as possible will be immediately spent or consumed. And that's what economists sometimes call a multiplier effect. You know, you increase demand for a particular product that is produced in an industry that has high unemployment. By boosting demand for that product, you will increase the demand for workers in that industry. So the employers, the companies will hire more workers. Those workers will earn more money. They will go out and spend it themselves on other goods and services. that will put people in other industries back to work. And those workers in those other industries will then go out and buy more of whatever they buy in terms of goods and services. And that's how it's sort of multiplied. In that multiplier story, what was critical is that I was having people not just get jobs, but spend the money that they earned from those jobs. And that is because for stimulating demand, we want people to consume. We want to get people to go out and spend. Otherwise, if they just get higher income and they just don't go out and spend it all, they just keep it, then it's not going to get multiplied. It'll do some good. The higher income will do people good, but it won't get multiplied. It won't help boost demand in a big way if it's just held in household savings accounts. So in a time of weak demand and high unemployment, we want people to consume. And back in the Great Recession, Larry Summers talked about 3 T's that make for good stimulus. Those 3 T's were that good stimulus has to be timely. It has to get out quickly. It has to be targeted, which really means well targeted, like targeted to go to the people that are most likely to spend it as fast as possible. And then the 3rd T was temporary. Stimulus is designed to be a short-term measure. We want it to move forward demand for goods and services, not permanently increase demand for goods and services, but move forward maybe consumption that would have happened next year. Consumption is good, saving is bad when you're trying to boost demand. On the other hand, if the goal is to boost supply, we want to increase the productive capacity of the economy, and we want to encourage this supply side increase in a way that it lasts and it will produce income into the future, not just be all used up today. So for supply side policy, we want the policy to encourage saving because we want it to stick around. It'll support future consumption, and we don't want it to just be consumed away today because that'll do some good today. It'll make people feel better off, but it won't last. So it will only boost the economic activity today. If it's immediately consumed, it won't last till tomorrow. It won't contribute to the productive capacity next year and the year after. So notice that on the one hand, if you're trying to boost demand, you like people to consume the tax cuts or the spending. If you want to boost productive capacity, supply side, you don't want them to consume it all. You want people to save it and let it stick around. Expiring policies, I mentioned temporary as a good quality of a stimulus policy. Expiring policies can be good to boost demand because if you know they're going to expire, if it's like a temporary tax cut, you're more inclined to bring forward consumption. While with supply side policies, you might want them to happen quickly, like you might want an investment to take effect quickly and build our productive capacity fast, but you'd want it to be maintained over time. You don't want it to go away. You're not just trying to shift forward supply side capacity. You're trying to build supply side capacity that sticks around in the future. The third question is what I think too often gets neglected by policymakers, and that is, how are you going to pay for it? Where is the money coming from? The financing source matters for who gets paid and what price. If the money comes from government issuing debt, this is what we call deficit financing, because if the money's not going to come from raising taxes or reducing spending somewhere, it means that it'll increase the government deficit and add to the federal debt. And the question is, who holds the government bonds? Like where's that money really coming from? It's coming from bondholders. And much of that government debt is actually held by foreigners, individuals and governments, which implies much of the income that does end up getting repaid to those investors, the principal and interest payments, will end up going to those bondholders, many of whom are foreigners, not necessarily other Americans. So as the debt is repaid or rolled over, we service the debt by paying interest costs. Every year, we pay down certain debt and issue new debt. It's rolled over time. And the cost to us, the way we pay those costs is through higher taxes or lower spending, either now or in the future. So there's no such thing as free debt. It will have to be paid back in the form of future higher taxes or future lower spending. If the money comes from money creation, so this is often touted as an easy fix. Oh, we'll just print more money. But unfortunately, you can't just create money that will have actual real value if you're not also boosting the productive capacity of the economy at the same time. So the cost to us, it'll create inflation if there's sort of more money chasing less productive capacity. The cost to us will be higher prices and lower real incomes. The point is that this is still not free. So whether we deficit finance or we print more money, it's not free. So when is deficit financing helpful and when is it harmful? Deficit spending is actually quite helpful if the goal is to stimulate demand in a less than full employment economy, because it does bring consumption forward in time, ahead of income. The more you can increase current consumption and decrease saving, remember, the better it is at stimulating demand for goods and services in a recessionary economy. So that's when deficit spending is useful. And what we try to do, like during the Great Recession, we tried to do some massive deficit spending in order to stimulate the economy and to increase demand. But if we're in a full employment economy already, deficit financing will be harmful. And that's because the deficit is negative public saving. And if we deficit finance a tax cut, for example, we are imposing a sure dollar for dollar drop in public saving for the uncertain prospect of how much the tax policy will boost private saving. And so it means that national saving, which is the sum of how much saving the government is doing for our economy plus how much saving private individuals are doing for the economy, the sum will decrease because the drop in public saving is greater than the increase in private saving, which implies less productive capacities carried over to the future, and that's bad for the supply side. So deficit financing isn't always bad, but again, it always depends on the condition of the economy, the starting point, and what the goal of the policy is. I just want to note that Penn Wharton budget models tend to focus on longer-term effects on the supply side of the economy, which is why in our analyses, deficit financing really is a handicap for policies looking good in terms of longer-term economic growth. And it's because we really capture a longer-term time frame over several decades, and we focus on modeling the supply side of the economy. So that's the end of the macro overview. And, as I said, the macroeconomic effects are focused on GDP, what's the effect on jobs, what's the effect on capital accumulation. That is a summary measure. It's a total effect or an average effect. But GDP doesn't always equal happiness. It doesn't necessarily reflect social well-being. It might be mostly correlated or often correlated, especially if you look across countries, because when you have higher GDP, you often have higher GDP per person. So on average, having a stronger economy translates into higher economic well-being. But of course, the distribution can really differ. So even if per capita GDP is higher for one country over another, the distribution of that GDP can be very different. And so that's the first point, this is to caution you that aggregate economic numbers do not translate directly to social well-being or happiness. So aggregates or averages aren't the same as a typical or representative household's experience. So even if we were thinking about, in a median household, the average is often poorly correlated with the median because of the skewness in the distribution of income. Second, not everything that we value is exchanged or priced in the marketplace. GDP is a market-based measure of the level of economic activity. Also, not all prices reflect true intrinsic values, social values. As I mentioned, society's well-being may depend on the distribution of well-being, not just the sum that we care about. Everyone in society cares about how resources are distributed, not just what the total level of economic activity is. And the purpose of distributional analysis that economists do, especially in the tax policy world, we tend to look at how tax burdens are distributed across different types of households, typically at different income levels. And that is something that we will focus on heavily in our different modules, our different elective topics. So let me recap to summarize the different economic effects and trade-offs that we've talked about today. We started by discussing the goal of policy, the role of government to maximize economic activity, reduce inequality, raise revenue efficiently, pursue other social goals. These are all different possible goals of government intervention in the economy, and they often trade off against each other. In terms of the microeconomics, we saw that substitution effects from relative price changes caused by policies often work in the opposite direction of income effects, and often we can't predict the overall effect or total effect of a policy on behavior and decisions, and it becomes an empirical question. There are a lot of economists that spend a lot of time trying to figure out which of these effects dominates based on past data, based on current observable data in terms of, what we can see in real time. But it's often difficult for economists to sort out the income from the substitution effect because we don't see these forces separated. We just see them happening at the same time. And so it's often very difficult to predict. And it's often very difficult to even go back to past realizations of decisions and tease out the substitution from the income effect. In terms of the macroeconomics, we saw that the policy prescription for treating a lack of demand can be really different from what we want to do to increase the productive capacity of the economy over the longer term. So short-term counter-cyclical or policies to address a recession can be really different from policies that are designed to grow the supply side of the economy. So that's a big trade-off. When we want to stimulate demand, we're typically thinking about steering resources, steering dollars toward people that are constrained. So those tend to be lower income households. That'll make the most difference in terms of increasing demand. When we're trying to grow the supply side, the long-term capacity, we're typically thinking about the negative effect of taxing high-income people, because unfortunately those high-income people have the greatest productive capacity and have the most discretion to increase labor supply or increase saving. So as we raise taxes on those households, while there may be a good reason to do that from a distributional standpoint, the cost or the trade-off is it may discourage supply-side economic activity. So that's the big trade-off. And when we think about any policy that's designed to be redistributive in nature, to reduce inequality, tax high-income people more, to subsidize or transfer more resources to lower-income households, both of those sides of the policy, whether you're taxing high-income people or subsidizing lower-income people, the substitution effects can work to discourage productive capacity, because either you're taxing the returns to labor income and to capital, or you're allowing people to work less and collect more income, because a lot of our policies addressing low-income households are designed to serve as a safety net, in that the lower your income, the greater the subsidy you would receive from a program. So there's this equity efficiency trade-off. We talked about the leaky bucket, the idea that if taxes on the rich are very distortionary and maybe subsidies toward lower income households are also distortionary, then as we move resources from rich to poor, the cost will be some loss in economic activity it just doesn't happen. And that's the trade-off between promoting greater equity or equality in resource allocation and maximizing the size and the efficiency of the macroeconomy. So that's the end of today's class on the basic economics of tax and spending policies. We'd like to encourage you to complete the online feedback form after viewing this lecture if you want to receive credit for it because you are enrolled in our Penn Wharton Budget Model Certificate Program for Policy Professionals. Please visit our certificate program page to learn more and apply. And I hope to see you at a future lesson, a future briefing on the Hill. Thanks.